Hello everyone, this is Ted Bauman here, editor of the Bauman Daily and the Bauman Letter. This week has been one of those weeks that really reveals a lot about the nature of the stock market, about the US economy, that right now things are largely founded on hope. We've seen a lot of negative news coming from the top of the food chain in terms of finance and economics, people like Chairman Powell, most of the global predictions coming out of the big institutions like the World Bank and the IMF, etc., all saying things are going to get worse before they get better, and yet stock markets continue to rise. Although we did see a significant trend this week, which was a shift away from the very top performers in the market, the growth stocks, the big techs, towards value stocks, something that I've been predicting for some time. In fact, something that Clint Lee and I discussed in the video that came out last week, Monday, where we predicted exactly that people would begin to realize that the top technology stocks were at the peak of their valuations. They couldn't go any higher without getting safely or rather unsafely overvalued. And so people were going to start looking for value further down the stock market. And that's precisely what we've seen happening. Another one of my predictions that has turned out to be absolutely correct is the rebound in residential housing construction. We've seen powerful upward moves in housing stocks that are geared towards building lower cost entry-level multifamily housing, condominiums, apartments, things like that, exactly as I predicted, for the reasons that I predicted, because they are so badly undervalued, and because people are continuing to transact virtually, not directly by going to visit houses, but by doing so online. So it's good to be right. Now, let's talk about what is driving the rest of the market. Today, I want to review a couple of different articles that I came across in the press. One was from the fabulous website Zero Hedge, which I read regularly. Don't agree with everything I see there, but a lot of it rings true. Also from Bloomberg, an article discussing the distribution of behavior in the stock market today. And I want to review that by going through a number of slides. The first slide shows really the relationship between algorithmic trading, the blue line, and discretionary trading, which is trading driven by individual fund managers, active traders. As you can see, there was a big drop in systematic strategies because algos couldn't handle the drop in the stock market in the beginning of, or end of February, beginning of March. And what we've seen recently is also a decline in the behavior, or rather the investment activity of individual traders, not individual retail traders, but institutional traders, the actively managed portfolios. So basically there has been a backing away from the stock market on the part of big institutions, whether they are driven by systematic algorithmic trading or by individual decision making. Now let's look at a second chart which shows liquidity. Liquidity is a big issue for me in the stock market. One of the things I always want to know is how many people are transacting a given stock on any given day. Now what we can see here, according to this chart, is that the liquidity for the average stock is only at the 18th percentile of its norm. What that means is that essentially stocks are trading at below 20% of their normal trading value, or volume rather. Now what that typically means is that although there is trading going on, it's not happening at the volume levels that are normal. Now when that happens, when you have lower trading volumes, lower liquidity, you get bigger bid-ask spreads, you get more volatility, you tend to get more rapid price swings because there are fewer participants in the market to smooth out the swings. So a lot of what we're seeing lately is effectively a withdrawal from the market of people who normally trade it. The institutional traders, we're seeing that reflected in lower liquidity. Now, where's that new liquidity coming from? Here is another chart. This shows a Google search for how to buy stocks. And now, as you can see, there has been a tremendous uptick, or there was a tremendous uptick in March in the number of people who were searching for that term, and it's continued to be relatively high as the year has progressed. You can see regular spikes. I'm guessing that those spikes probably occur either on the weekends or on Mondays, at times when people are have a little bit of time to focus on things like the stock market. But what it tells me is that while we've seen a big withdrawal of institutional players and their money from the stock market, lower trading volumes, lower liquidity, there has been a burst of interest from the average public individual trader. Now, this next chart shows precisely that. It shows the number of stock positions held at Robinhood, which, as you know, is a free trading platform that you can access on a cell phone. Post the COVID-19 lockdown, starting in mid-March, you can see a dramatic uptick in the number of people who are trading stocks. Essentially, the number of stock positions held at Robinhood, which is a good proxy for individual traders, has practically doubled since the beginning of the crisis. Now, this next chart shows that individual investors are trading much more actively in shares, and you can see that by looking at the relationship between the volume of trades and the basically small trade sizes, the proportion of trades that are being traded for relatively small amounts, not the big institutional guys who are buying hundreds and thousands of shares at once, but relatively small ones. As you can see, in terms of both shares and options trades, the number of small trades has increased, which is exactly what you'd expect given the fact that there are so many more people trading on Robinhood, people looking for advice about the stock market. So you can see some of the kinds of companies that are receiving the attention on the right-hand side. Google, Shopify, again, many of these different companies, Amazon, Tesla, Netflix, these are all buzzy stocks. These are story stocks, stocks that people are looking at and saying, I've heard about that, I've read about it, I saw it in the news, that looks exciting to me, let me try it. What this all says to me is that there has been a burst of interest in trading in the stock market coming from relatively small investors with small amounts of money to invest, who are dabbling in it for the first time. Now, that's not necessarily a bad thing, but remember that that's not the normal behavior, that's not the normal pattern of the stock market. It's not a normal scenario where big institutional investors are shifting their money into money market funds, basically parking it off to let it ride out the storm, while mom and pop investors pile in to try to play the stock market. Now, there have been a lot of interesting speculation about why that's the case. Matt Levine, one of my favorite columnists over at Bloomberg, says he thinks it's because people are looking for entertainment. They can't go out, they can't do much. As he put it, they've finished watching everything on Netflix. So now they're looking for something else to do, and trading stocks is a time-consuming activity, as I can tell you, as somebody who spends all of my days looking at the stock market. So is that true? Is that what's happening? Are people doing this on a lark? Are they simply trying to replace the thrills that they'd be getting elsewhere by going to casinos or going to amusement parks, riding roller coasters, etc.? I'm not sure that's the only reason, but certainly there seems to be a significant uptick in the participation at the lower end of the market by retail investors. Now, you can still have rising stock prices at low liquidity and low volumes, and that's exactly what we've seen. The problem is that it's not sustainable because eventually those people will either run out of money or stocks will reach a top and it will not be possible to push them any higher. They'll reach valuations that don't make any sense, at which points people will start to try to take profits and they'll fall again. Fundamentally, without the participation of the big investors, the institutional markets, the pension funds, etc., you really don't have a sustainable path to a bull market. Now, let's look at where people are getting the resources. Here's a fascinating chart that again came from Zero Hedge. This chart shows basically the expenditures that saw the highest week-over-week changes by households which had received their stimulus checks versus those that did not get them. So essentially what somebody did is they went out there and they compared what people who'd got their stimulus checks were spending their money on versus those who didn't. And they ranked those things according to the fund flows coming from those households. Now, obviously, most people put things into savings or loans. Some of them put them in, withdrew them as cash. But look at the pattern for people in the 35,000 to about 150,000 income categories, excepting the 75 to 100K category for some reason. They were putting their money into securities trades. Now, what that tells you is that a lot of people increased their securities trading activity after they received their checks. So again, you have free trading on Robinhood, you have a lot of bored people at home, you have rather checks that came into households, and it seems logical to assume that a lot of people decided to use those checks to play the stock market. Not exactly what Congress had in mind when they put them out, but that is the case. Now let's look at the next chart that shows the relationship between the cumulative level of the S&P 500 and fund flows. In other words, the amount of money that is flowing into the stock market. Now, as you can see, since the mid or sort of towards the end of April, we've seen a significant drop in the amount of money going into the stock market, accompanied with a continued rise in the stock market. Now, when the stock market bottomed seriously at the end of March, you saw a rise in fund flows as institutional investors basically, I think, tried to grab stocks at value. That then peaked in mid-April, mid to late April, and now those institutional investors have peaked or have left the market and are sitting on the sidelines, but prices are still going up at lower trading volumes and lower fund flows. Now, look at what's tended to happen in the past when that happens. When the flow of funds into the market declines significantly, you sometimes get a short-term peak afterwards, but there inevitably, I think it tends to be that the market will finally start following the flow of funds downward for precisely the reason that I am articulating, which is that small institutions or small individual investors cannot sustainably drive a bull market indefinitely. Now, what does this all mean in terms of the individual investor, i.e. maybe somebody like you? Well, as I've said all along, I think that the notion that we can be considered to be in a bull market is bunkum. I don't think that that's true at all. I think what we're seeing is an understandable desire for people to try to replicate what they have heard or experienced coming out of the 2008-2009 financial crisis, which is that if you buy the right stocks at the bottom, you can make a great deal of money very quickly. Certainly that's understandable. There's been huge volumes of words written about the aftermath of that crisis since it happened, and so a lot of people are aware of the opportunity that exists there. But that doesn't change a fundamental fact about how the stock market and the flows of funds and the flows of value embedded in the stock market happen in terms of the distribution across different types of people in the economy. That's a particularly important consideration. Let me show you two further charts that illustrate what I mean. This first chart shows that in times of recession, the share of equities held by the wealthiest households in the country tends to drop quite rapidly. In other words, when the economy begins to decline, they sell their shares. They try to distribute their shares to somebody else. They don't want to be in the stock market when this is happening. And of course, being extremely wealthy, they can afford to lose some money on stocks without having it be the end of the world for them. When the stock market is rising reliably, then they will put their money into the stock market. But as soon as there is a defined turn in the stock market, they tend to pull out. The next chart shows the share of equities owned by the bottom 90%. Now, what you can see is that the behavior is absolutely the opposite. When there's a depression, the people at the bottom tend to buy more stocks. They tend to pile into stocks, and then when the stock market rises again, they tend to pull out of stocks. And partly that's because wealthier households are moving in, but largely it's because they are, in a sense, they're selling stocks. They're basically selling them out of the market. So essentially what you have is a situation where the very wealthiest households in a time of crisis sell their stocks, and the less wealthy households buy their stocks from them. Now, is that a good thing to do? Well, it depends on the individual stock, doesn't it? I think what we've seen, particularly in the last couple of weeks, given the liquidity levels and the trading volumes, is that we've seen a lot of profit taking going on I think institutional investors have been willing to sell their stocks to individual investors who believe that they're going to continue going up ad infinitum. Well, as we know, nothing ever goes up ad infinitum. And my biggest concern, what I've been talking about all along this year, is that eventually this is going to run out of steam. I think it's still possible to achieve good gains if you look in the right places. But trust me, folks, looking at the story names, the Teslas, the big names, the Googles, the Alphabets, that's not going to do it. In fact, this week we saw a significant pullback in the share prices of some of the very top companies, and we've seen a rotation into value. Again, that's something I've been predicting for some time. That's exactly what we expect to see. The question is, are these individual traders with their Robinhood apps on their phones going to recognize that opportunity? Are they going to be able to identify, for example, real estate investment trusts in beaten down sectors that actually have the potential for 20 or 30 or 40% gains over the next 6 to 12 months because they're so far undervalued? Probably not. That's probably because most of the big investment websites don't write about those companies. That's precisely why here at the Bauman Letter, that's exactly what we do. We try to point out the opportunities that are not likely to run out of steam because the market is actually subtly working against them under the hood. What we're trying to do is to identify the stocks that are going to bounce back and where the opportunity to regain their previous highs is strongest. If you do that, you could pick up big double-digit, even triple-digit gains in short order. So it's a different investing game out there, folks. It's not one where you can go along for the ride. And if you're investing on the basis of the latest hot stock, if you're investing because you like the way that Elon Musk behaves on Twitter, that's probably not the best way to use your money, especially if you got it from a stimulus check. Instead, you should be looking for deep value opportunities right now, because eventually those are the ones that are going to give you the biggest short-term returns. Now, the big danger, of course, is that people end up buying stocks as wealthier households shed them, and then they stagnate and begin to lose value, which we've already seen happening, as I said, with companies like Alphabet, etc. So don't let that happen to you. Make sure that you understand the changing nature of the market and look for the deep value. And that's where I think the Bauman Letter comes in. Click here if you would like to consider subscribing to it. That's why we exist, to try to help you find that deep value. In fact, in next month's issue, we're going to be presenting some incredible opportunities that I think nobody else is looking for, or at least not very many people are looking for. They're the kinds of things that are going to give you the big gains while the other stocks eventually peter out as retail investors realize that they're not sustainable. Anyway, this is Ted Bauman signing off. Please have a great weekend, stay safe, and I'll talk to you again next week. Take care.